The Standard & Poor's 500, aka the S&P 500, is perhaps the most iconic feature of the investing world. We see it every day and night on news channels around the globe, and it's been referred to many times in some of Hollywood's biggest financial movies.
You ever wonder why fund managers can't beat the S&P 500? Because they're sheep. Sheep get slaughtered.
But to many, the S&P 500 is an enigma. They know it represents Wall Street, the financial markets, and maybe prices, but beyond that, it's a mystery. Unbeknownst to the majority, the S&P 500 is the embodiment of the financial markets, the magnum opus of capitalist America. Now that we have the fancy introduction out of the way, let me tell you what I'm going to tell you. First, I'm going to explain in plain English what the S&P 500 is. Second, I'm going to tell you everything you need to know about the S&P 500 and its inner workings. And third, I'm going to show you how you can invest in the S&P 500. I can guarantee that if you watch this video until the end, you won't have to watch any other videos on the S&P 500. In fact, I'm so confident in that guarantee that I'll ask you to leave a like and subscribe now. And if you're not happy by the end of the video, you can take them right back. All right. Let's get started. So as we mentioned in the introduction, the S&P 500 is the abbreviated name for the Standard & Poor's 500. But who or what is Standard & Poor's? Standard & Poor's is one of the largest credit rating agencies in the world. They look at debt which is issued by companies and countries and assign a letter grade to that debt. They do this to show investors how risky that debt might be, with AAA being low risk and D being very high risk. You might remember this famous scene from The Big Short.
If we don't give them the ratings, they'll go to Moody's, right down the block. If we don't work with them, they will go to our competitors. Not our fault, simply the way the world works.
But Standard & Poor's are also an index provider, and the S&P 500 is an index which they provide. So what is an index? The definition of the word index in the English language is a sign or measure of something. If we were to have, say, a stock market index, that would translate literally to be a measure of the stock market. In the world of the financial markets, an index is a tool which measures the performance of a collection of investments. Different indexes or indices will measure the performance of different collections of investments. According to Standard & Poor's, most indices fall under one of the following 5 categories: equity indices, fixed income indices, commodity indices, strategy indices, and economic indices. The S&P 500 is an example of an equity index. So if the S&P 500 is an index, what exactly does it measure? The S&P 500 index measures the stock performance of the top 500 companies in the United States. When we talk about measuring performance, we're talking about the increases and decreases in the share price of all the companies measured by the index. But how does Standard & Poor's determine which companies are in the top 500? The answer is market capitalization, aka market cap. Market cap is the value of a company as determined by the stock market and is calculated as the number of shares available to trade multiplied by the share price. Therefore, the top 500 most valuable companies in the United States as determined by market cap will be included in the S&P 500 index. There are some other conditions which a company must meet in order to be included in the index, including minimum valuation, positive earnings, and healthy liquidity. So we get that the S&P 500 is a stock market index which measures the stock performance of the 500 largest companies in the US. But why do people care so much about the S&P 500? The S&P 500 covers 80% of the total value of the US stock market. Therefore, it's fair to say that the S&P 500 index is representative of the US stock market as a whole, meaning if the S&P 500 index is performing poorly, then the US stock market is performing poorly. This index allows investors and prospective investors to access real-time information about the health of the financial markets. As the old adage goes, when America sneezes, the world catches a cold. Hence why global markets are fixated on the performance of the S&P 500. As well as this, many fund managers who are investing their clients' money on their behalf will use the S&P 500 index as a benchmark for performance. You've probably heard the phrase beating the market. Well, the market is the S&P 500. So from a fund manager's perspective, move, they'll want to earn a return for their clients that outperforms the return of the S&P 500. Why? Well, because if they don't, the client would have been better off saving the money they spent on professional fund managers and instead investing their money in the market as a whole. But more on that later. To recap so far, we've defined what an index is, we've explained what the S&P 500 index measures, and we've talked about why people care so much about the S&P 500. Now let's explore what companies are included in the index and the impact that each of these companies have on the index as a whole. If you're enjoying the video so far, make sure you leave a like and subscribe. As of the 31st of January 2022, we can see that the top 10 companies in the S&P 500 were Apple, Microsoft, Amazon, Alphabet Share Class A, Tesla, Alphabet Share Class C, Meta, Nvidia, Berkshire Hathaway, and Johnson & Johnson. These companies are ranked in accordance with their respective market caps, i.e. Apple being the most valuable and Johnson & Johnson being the least. What's important to understand is that the higher a company is ranked within the S&P 500, the more impact that movements in the company's share price will have on the performance of the index as a whole. This is what's known as market cap weighting. Essentially, a 10% fall in the stock price of Apple will have more impact on the overall performance of the S&P 500 as compared to a 10% fall in the stock price of Johnson & Johnson. That's because Apple has a larger market cap than Johnson & Johnson and is therefore given more weight in the index. The top 10 companies in the S&P 500 account for 29% of the total market capitalization of the index, with Apple alone accounting for over 7%. This is why the performance of the stock market can really hinge on the performance of a handful of companies. Looking at the different sectors included in the S&P 500, we can see that the index is dominated by IT companies, which is unsurprising. But clearly the S&P 500 as an investment choice would represent a diversified option for investors, simply because of the number of companies included within the index and the variety of sectors in which they operate. As of the 31st of January 2022, the total value of the S&P 500 was over $40 trillion. So now that we understand what the S&P 500 is, let's talk about how you can invest in it. The first thing we need to clarify is that investors cannot invest in an index, but they can invest in an index-linked product. Let me explain. We mentioned earlier that Standard & Poor's are an index provider. Their job is to maintain and calculate the index, but the index itself is not an investment product. Instead, Standard & Poor's licenses the index to financial institutions such as Vanguard, who use the index to make investable products like exchange-traded funds, aka ETFs. Therefore, an S&P 500 ETF offered by Vanguard is an index-linked product, which you can invest in. The goal of these products is to replicate the performance of the index which the product tracks by owning the same collection of investments tracked by the index. An S&P 500 ETF will allow you to earn the return of the market, because remember, the S&P 500 index represents 80% of the total market capitalization of the US stock market, meaning it's representative of the market as a whole. So why would you want to invest in the S&P 500? This investment would constitute a passive investing strategy as opposed to an active investing strategy. Active investing strategies try to earn a return that outperforms the market, whereas passive investing strategies are aiming to mirror the performance of a particular index. Over the long term, most active fund managers have failed to outperform the S&P 500. Plus, passively managed funds come with less charges than active funds. In fact, in 2019, it was found that the average passively managed fund was 10 times cheaper than the average actively managed fund. As well as this, the likes of an S&P 500 ETF allows investors to access a highly diversified investment product and gives them total transparency and visibility over the investments which the fund owns. That begs the question, how do you invest in these products? It's really as simple as signing up to an online brokerage and accessing the many index-linked products available on those platforms. If you're from Europe, you can sign up for a free brokerage account with DeGiro or BookZero by using the links in the description of this video. If you're from the US or elsewhere, it's just a matter of researching which online brokerage is best for you. Not all S&P 500 products are the same. Different products will have different fee structures, different policies for paying out dividends, and different strategies for protecting international investors against currency currency changes. What's important is that the product chosen aligns with your own personal circumstances and what you're trying to achieve with your investments. Before you invest in any S&P 500 product, you should read the fact sheet associated with that product. This report tells you everything you need to know about the fund that you're looking at. These can be found easily through a quick Google search. So that covers the main points you need to know about the S&P 500. You could spend lots of time discussing every little detail about the index and index-linked products, but I wanted to keep this video as straightforward and to the point as possible. With that being said, let me know if you have any questions on the S&P 500 in the comments, and I'll answer each and every one of them. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like in the video, subscribe to the channel, and I'll see you in the next one. Cheers!